There's a quiet moment that doesn't get talked about very often. It happens late at night. The apartment is quiet. The dishwasher hums softly. A phone screen glows in the dark. And for the first time in years, the savings account shows a number that feels solid. $20,000. Or the equivalent in euros or pounds. It's not a lottery win. It's not life-changing money. But it is something. It represents restraint, discipline, deferred dinners, fewer vacations, a used car instead of a new one, years of small decisions. And yet, instead of relief, something else appears. A strange tension. Because once that number is real, the question quietly shifts. It's no longer, can I save? It becomes, what is this money supposed to do? It doesn't feel like wealth. It doesn't feel like freedom. It feels exposed. Suddenly, the savings account looks small next to housing prices, small next to retirement projections, small next to friends buying homes, small next to social media posts about investing in net worth milestones. 20,000 is too much to ignore, but too little to feel safe. And that's where the psychological shift begins. No one announces it, no one teaches it, but something subtle changes once you cross that threshold. Because before 20,000, the goal is simple: build a buffer. After 20,000, the system starts pulling in different directions. One voice says, invest it, don't let it sit. Another says, keep it safe, you might need it. Another whispers, you're behind. That's the uncomfortable realization. Saving $20,000 doesn't end financial anxiety. In many cases, it simply changes its shape. Let's follow one household. Mid-30s, no dramatic backstory, no extreme debt, no six-figure tech salary. After taxes, their combined income is about $6,200 per month. In Germany or the Netherlands, the number might look similar in euro terms. In the UK, perhaps slightly less. The exact currency doesn't change the pattern. Rent is $1,950. Utilities and internet add another $320. Car payment $410, insurance $140, fuel $160. Groceries run about $700, student loan payment $380, health insurance premiums $420, phone plans, streaming subscriptions, cloud storage, music, small software subscriptions, together around $120. A modest gym membership $60. Dining out and small weekend spending around $400. Nothing extravagant. No luxury cars, no designer wardrobes, no exotic vacations. At the end of the month, about $600 remains, some months less. For years, they quietly transferred $500 of that into savings, occasionally more when tax refunds arrived, occasionally less when car repairs appeared. And after 5 years, the number finally reached $20,000. It felt responsible, mature, controlled. Friends noticed subtle differences. Some were buying homes, others were traveling more frequently. A few had started investing aggressively and talking about market returns. Our household didn't feel behind exactly, but they felt paused. Because now $20,000 sits in a high-yield savings account, earning a modest interest rate. It doesn't grow quickly, but it doesn't shrink either. And every month, that same $600 margin still remains, just enough to build, not enough to feel transformative. The lifestyle hasn't changed, the stress hasn't disappeared, the job still matters deeply, the paycheck still carries the weight. The only visible difference is that the bank app shows a 5-digit cushion, and that cushion creates a new internal dialogue. Is it too much to leave idle? Is it too little to invest meaningfully? Is it enough for a home down payment? Or is it simply a number that looks bigger than it feels? Here's the subtle pattern most people don't notice. The financial system is designed to make $20,000 feel both powerful and inadequate at the same time. Banks celebrate it. Marketing emails start arriving. Make your money work harder. Exclusive investment opportunities. Upgrade your financial future. At the same time, housing markets, retirement calculators, and cost of living headlines quietly imply that $20,000 is barely a starting line. So psychologically, it creates tension. The system nudges you away from holding cash. Inflation headlines remind you that money sitting still is losing value. Investment platforms make opening an account effortless. A few taps and the money moves. But job markets remain volatile. Health costs remain unpredictable. Rent increases happen with little warning. The same environment that encourages you to deploy your savings also makes that savings feel fragile. And here's the design feature that matters most. Monthly expenses have been structured to absorb nearly all income. Subscriptions auto-renew. Car loans are fixed. Rent adjusts upwards slowly. Insurance premiums rarely go down. So even after building $20,000, the monthly margin doesn't meaningfully expand. The system rewards consumption consistency. It does not naturally create expanding breathing room. So what happens next for many people is not a dramatic mistake, it's subtle drift. A slightly nicer apartment, a car upgrade justified by "we have savings now," a vacation that feels earned. Individually reasonable decisions. Collectively, they maintain the same ratio. Income nearly equals expenses. The $20,000 remains, but the dependency on monthly income stays intact. That's the quiet pattern. Saving $20,000 often stabilizes life. It does not automatically change its structure. Let's stay with the numbers. The household saves $500 per month. That's $6,000 per year. Over 5 years, that built $30,000. After small emergencies and uneven months, it became $20,000 net. Now imagine they continue the same pattern, another $6,000 per year. In 5 more years, they could reach roughly $50,000, assuming no major disruptions. But here's the quiet math that rarely gets spoken. Their core expenses are about $5,600 per month. That means $20,000 covers roughly 3.5 months of life. Not a year, not even 6 months, 3.5. At $50,000, it would cover about 9 months, and that's before factoring inflation. Now shift perspective slightly. If instead of allowing lifestyle to expand, monthly expenses were reduced by even $400, the math changes. Expenses would drop from $5,600 to $5,200. The same $20,000 would now cover nearly 4 months instead of 3.5. At $50,000, closer to 10 months. That's not dramatic, it's not viral content math, but over 10 years, $400 per month equals $48,000, almost another full emergency fund. The numbers are not extreme, they're quiet. And that's the point. What really happens after $20,000 isn't explosive growth. It's a slow negotiation between margin and lifestyle, between stability and expansion, between optionality and maintenance. The math doesn't shout, it whispers. None of this happens because people are reckless. It happens because of normalization. When peers upgrade apartments, it recalibrates what reasonable looks like. When coworkers talk about renovations or investing aggressively, cash savings feel unsophisticated. Status today is subtle. It's not luxury watches, it's neighborhoods, travel frequency, school districts, investment portfolios. And for middle-class households in the US and Europe, identity is often tied to stability. Owning rather than renting, driving something reliable, providing experiences for children, keeping up quietly. There's also fear of stagnation. Holding $20,000 in cash can feel like standing still while inflation headlines scroll by. Markets rise, housing prices climb, retirement targets stretch further away. Doing nothing feels like falling behind. So intelligent, responsible people make incremental upgrades. They're not chasing extravagance, they're chasing alignment. Alignment with peers, alignment with perceived adulthood, alignment with a version of life that feels on track. And because these changes are gradual, they don't feel dangerous. A slightly higher rent, a modestly higher car payment, an investment account opened with optimism. None of it looks irresponsible.
But psychologically, the presence of savings reduces perceived risk, which quietly increases tolerance for fixed costs. And that's the paradox. Savings are meant to reduce dependence on income, but emotionally, they can increase comfort with maintaining the same dependence. If nothing dramatic changes, life continues. The household keeps working. Income rises slowly, expenses rise alongside it. Savings hover between $20,000 and $40,000, occasionally higher, occasionally lower after emergencies. There's no crisis, but there's also limited flexibility. Changing careers feels risky because income is still required monthly. Taking time off feels impractical. Relocating becomes complex due to fixed commitments. The emergency fund protects against short-term disruption. It does not create long-term optionality. And over decades, that distinction matters. Because retirement savings must grow separately. Housing costs continue adjusting. Healthcare expenses increase with age. Children's education, if applicable, introduces new variables. Without structural margin, progress remains linear. Work longer, save incrementally, hope markets cooperate. Again, this is not failure. It's simply constraint. Constraint means choices are narrower. Not impossible, just narrower. And that's what really happens after saving $20,000 for many households. Life stabilizes, but it doesn't necessarily expand.
Financially calm people often think in terms of margin first, not income size, not investment returns, margin. They look at how many months of life their savings can cover. They measure time more than totals. $20,000 is not viewed as a milestone. It's viewed as a unit of time. 3 months, 4 months, perhaps 5. And the goal quietly shifts toward increasing that time buffer. Not through dramatic risk, but through widening the gap between income and obligation. They also think in terms of optionality. Optionality means the ability to say no to a job, to a relocation, to an expense that doesn't align. Savings becomes less about growth and more about flexibility. There's also a focus on risk reduction. Lower fixed costs mean fewer points of fragility, less exposure to interest rate changes, less dependence on perfect health, less vulnerability to a single employer. It's not about extreme frugality, it's about structural resilience. And here's the subtle shift. Instead of asking, how can this $20,000 grow faster? The question becomes, how can this $20,000 buy time? Time to think, time to choose, time to adapt. Growth still matters, but calm comes from reduced pressure, from knowing that life does not collapse immediately if income pauses. That's the mental reframing. Not accumulation for status, but accumulation for stability. Saving $20,000 is significant. It represents years of discipline in a system that absorbs income quickly. But what happens after that milestone depends less on markets and more on structure. If expenses quietly expand, the number stabilizes life without transforming it. If margin gradually widens, the same number begins to represent time. Neither path is dramatic. Neither guarantees outcomes. This discussion is purely educational and not financial advice. It's simply an observation of patterns that appear again and again across households in the US and Europe. $20,000 doesn't change your life overnight, but it does reveal something. It reveals how your financial system is built and whether that system is designed for maintenance or for flexibility. And sometimes clarity is more valuable than acceleration. If this helped clarify things, consider subscribing.